Hey, how's it going, everybody? In today's video, I'm going to be talking about the VIX and a couple of different instruments that are used to trade the VIX, such as UVXY and VXX. The VIX is an instrument that tracks the market volatility, but it can also be used as a hedge to the downside to protect any long positions that you might have, or even profit when the market is going down. And it's typically used to measure the amount of risk that's in the market or the amount of fear that's in a current market situation. So in this video, I'm going to talk a little bit more in depth about what the VIX is and how it's used. I'm going to talk about some instruments that are used to trade the VIX, because you can't actually trade the VIX itself. You can only trade derivatives of it, like options, and then some of these other names that I'm going to talk about, VXX and UVXY. And at the end of the video, I have a trading strategy that I've backtested using TRENDSPIDER, and I'm going to show you some strategies for trying to trade VXX and UVXY, which are both instruments that track the VIX. So just a reminder, everybody watching, this video is going to be for entertainment purposes only. None of this is any sort of financial advice or a trade recommendation. So keep in mind when watching the backtesting that past performance doesn't necessarily indicate what's going to happen in the future. It's just telling us what's happened in the past and how a certain strategy has performed. And if you like this content, make sure you hit the like button, subscribe to the channel. I put out different kinds of videos on trade strategies and also individual stock analysis on different stocks and their current valuations. So the first thing that we need to talk about is, what is the VIX? And so the CBOE is who has created the VIX, and it represents the volatility of the market over the next 30 days, and specifically the S&P 500. And when we're talking about volatility, what we're really talking about is the variance or the deviation in the prices of the stocks, so how far they are moving from a certain mean value. And this typically happens to the downside in the market. Usually in market moves, when we're moving up to the upside, we're moving generally pretty slow, and then downward moves tend to be more violent. So this deviation is increasing typically in these downward moves. So we'll talk a little bit more about how the VIX is correlated with the S&P 500. And that's pretty important to understand, because usually we're trading the VIX as a sort of hedge or a short to the market in some way. So if we're looking here at a history of the VIX versus the S&P 500, you can see the times where the volatility increased in the S&P 500. Those were times when the VIX increased, and it increased very rapidly. So you look back at the NASDAQ bubble, you had all of these spikes, and the VIX was trading in this, relatively elevated area when it was more volatile here. 2008, 2009. Saw a really big spike in the VIX, and then it stayed elevated. And then you can see during this time from basically 2012 and on, the VIX was just really muted, a couple little spikes and just a little bit of noise, but a really low value as the S&P 500 just, continued to trade up. And it wasn't until we had the volatility from last March that we had another really big spike in the VIX. So if you go into your trading software and you look up the VIX, what you're actually looking at, that value is calculated by looking at the different prices of various out-of-the-money puts and calls. And it's this really complicated formula that we're not going to go into, but you can think of it as correlated to the standard deviation of the S&P 500's price movement. So this was a pretty interesting graph that I found, and it shows in the black line here the correlation between the S&P 500 and the VIX. And so you can see it's been negatively correlated, showing that when the S&P is going up, VIX is going down and vice versa. And it's been roughly about 70 to 90% correlated. So in a long portfolio, I may use a hedge on the VIX just in case we do have continuation to the downside, knowing that it's a relatively high risk to reward ratio, but a pretty low percentage win. But if we're going to do that, we have to know actually how to trade the VIX. And you can't actually directly buy or sell the VIX itself. If you could, I think that would be a really great trade. But the only thing you can do is you can trade different types of VIX derivatives. So there's lots of different examples of these. There's futures contracts and options, which with futures, you're also taking into consideration element of time. And then with options, you're taking into account volatility and time. I get some questions about options on this channel, and I'm not really super well versed in options beyond just the basics. So what I typically trade with is a lot of leveraged ETFs. And so what I'm going to focus on for here is more of these VIX-based traded products like VXX and UVXY. And these are basically just like buying a leveraged ETF or any other stock. You buy a certain number of shares, and if the VIX increases in value, these track the VIX in one way or another. There's lots of other VIX related products out there. These are some of the more heavily traded ones, so they're very liquid. And I'll just point out two different ones here. That's VXX and UVXY. The main difference between these two instruments is the amount of daily returns they're trying to replicate in the VIX instruments that they're tracking. So for the VXX, the way that it's priced is based on an average of futures contracts that come out to a 1-month maturity. And so you can really think of this as sort of a futures contract. So you do have that time element in the pricing, and that's why this is going to decay over time. You also have a fairly high expense ratio that's related to all the maintenance of a fund like this. So this is definitely more of a trading instrument and not something that you really want to hold on to for a long time. This or UVXY, either of them are going to slowly decay away if the market continues to just, kind of creep up. And the other instrument that we're looking at is UVXY, which what it's trying to do is get a little bit of leverage on the VIX. So it's looking for 1.5 times the daily returns. And it's comprised of first and second month futures positions that weighted out come to an average of maturity of about 1 month. So again, you'll see from a long-term chart of either one of these that these are definitely intended for short-term exposure. And so the last thing that I want to do is show one of the back-tested swing trading strategies that I looked at using TRENDSPIDER. And if you want to try and do a similar type of back testing, there's a link for TRENDSPIDER below. You can try it out for a week, I think, for free. And it's pretty neat. So if you have an idea of a trading strategy that you think is profitable and you want to test it out, it's a pretty intuitive, pretty easy thing to use. So I'm going to show you how I set up the VIX trading strategy using VXX. And I just like VXX a little bit more than UVXY to trade. UVXY moves really quickly and also just seems to decay a little bit more. So if I'm going over to TRENDSPIDER, you can see that there's only 3 years of history, which really isn't a great data set for us. And we've had a pretty at least once in my lifetime volatility event last March. So obviously this is going to perform very well. But the strategy that I set up is based on Heikin-Ashi candles, which I'll put a link to some of my other videos where I use this Heikin-Ashi candle. It's definitely nothing I came up with, but it's like a moving average candle, and it works really great for determining where short-term trends are. And so the first rule of the strategy is to open a trade on a bullish Heikin-Ashi candle, and then to close a trade on a bearish Heikin-Ashi candle. And just looking at that strategy, that yielded a 400% return. Obviously, the one trade from last March was 250% of that, but you can see it's a pretty low win percentage, and it was pretty high when it won. Obviously, maybe a little bit skewed results, but you can see how it performed back here as well. We had the volatility at the end of 2018, and there were a couple pretty good trades in there. But actually, if I come in here and I change one of the parameters, I add one more parameter, and that is if we close greater than 10-day moving average, that was able to improve the results and take out some of the false entries, at least over the last 3 years. So we'll see how that performed. And yeah, so that gets to 562%. It increased the win rate a little bit. And I tend to, when I do these, put usually a trailing stop on there, like maybe 2 to 3%. Just kind of depends on where I entered. Because typically when the market comes back after a downward move, it's a pretty violent move back up. And when you have those, you want to get out of this pretty quick. So that's it for the strategy. Let me know what your favorite strategies are to trade the VIX. Do you use options, futures, VXX, or one of these other kind of symbols? With the market at all-time highs, are you looking to trade the VIX? And if so, what kind of signal are you looking for of when to enter? Let me know in the comments section. Thanks for watching and have a great day.